Hello, Rita. Right, so we're on to idea number 9, and this is it. Um, if nothing else, you can say that I'm consistent because what you're looking at here is article number 1 of the Oak Bloke. So, article number 1 from the Oak Bloke was Cadence Minerals, and so therefore, I mean, is it altogether a surprise that it joins my ideas for 2025? I did struggle, having been criticised for speculative stocks. I did struggle to include it in some regards. The easy thing for me to do would have been to just come up with some fairly safe names, and I've got plenty of those. It's not difficult for me to look for value that carries very little risk. But hopefully, what I have done and what I am what I'm proposing is that this range of ideas kind of provides a and this, by the way, was the let's find it. It's this one here. Um, so this is uh, just one of the ways that could deliver a monster return in 2025. So the aim of my portfolio here is to deliver an overall 28%. This is just my estimation. None of this is investment advice. None of this is meant as recommendations. It's you make your own investment decisions. That's not up to me. That's up to you. But yeah, we've gone through so far are these eight ideas up to here, and so this was another mining idea. Um, and at the time I wrote the article, the price was that. You'll notice that since then, I think today it's actually technically that, but you can see it's down a fair chunk since I wrote the article as part of the 2025. So that's kind of the background to this. So what what let's run through the idea and let's run through what happened since I wrote the article. So I'll actually start here. So August the 28th, 2023 was my first article as the Oak Bloke, and 100 people read this article. And when you go back through it, I mean, at the time they held EMH that was a holding of 5 million. They held this a holding of 2 million. They held this a holding of 1 million. So they had 8 million, 8.2 million of listed equities. Just close this. Um, at the time, and these 8 million, at the time represented a vast discount to their NPVs. So, um, you know, fast forward 18 months, well, 16 months, and does this thesis still hold? Well, yeah, it's interesting. I mean, they sold off Hastings. Hastings has actually done very well since. They've not sold this down, but they can't. They've got a lock in. But EG1 is a lithium prospector, and as you probably know, lithium's not done terribly well. And this one's a lithium prospector, and same thesis. This has also been held up a little bit around achieving its final DFS. It's working. It's part owned by um, EMH. Part owns the mine, and the Czech government part own the mine. So they're working with their partner on that, and they've had to rethink some of the rationale. Um, Meanwhile, Cadence have been selling down their holdings. So actually, when we fast forward to December 2024, um, what 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 we'll see is that this EMH holding is now dramatically reduced. So it's let's see, it's the remaining portion is 450,000, which is point point two of a pence of a share, and uh, EG1. Again, you can see it here. It's reduced down. So this is, it's dropped by 90% because of the drop in lithium prices and so on. Um, so yeah, it is true to say that the holdings have dwindled. Sonora, meanwhile, is caught up in a legal battle with the Mexican government. So the Mexican government essentially said we're going to privatize lithium mining in Mexico, and obviously the legality of that's being debated. But the thing that's changed and changed dramatically is this final one, a mapper, and that's a mapper is essentially up until this article, which we're going to come to. A mapper is the core now of the valuation thesis. It's not to say that EG1 couldn't do well in the future or EMH couldn't do well in the future, but there's not much skin in the game. There is some hidden value in the sense that when EG1 hit certain milestones, that there's some follow-on awards of shares for Cadence, and so far the progress of EG1's been quite positive. That they've managed to, they've managed to find some interesting prospects, and they are located next to a very big lithium deposit. So it's again, you'd imagine that it's a contiguous uh, um, uh, resource to the one next door, which is which is yeah, which gives you some level of optimism. But I mean, it has, as you can see here, dramatically dropped in price. To be fair, back to where it was before the spike in lithium prices. It's as simple as that. Okay, so why did I include Cadence? So a mapper is an iron ore mine. It's a previously producing iron ore mine. It was owned by Anglo American. Um, the Brazilians are pretty optimistic, keen to get this mine reinstated. So it's got support from the state government. It's got support from the national government. So it is having to go through the various permits and so on. And there's one called an LO that's the final one to get, and then after that it's purely to get the funding underway and the construction built. So the economics of this mine are pretty phenomenal. It's a green iron ore, so green iron ore isn't that it's a different color iron. Nothing like that. It's simply that it's eco ESG. It's essentially a pure form of iron, which therefore um, doesn't require a blast furnace. It can be smelted through an electric arc furnace. And by doing so, the problem with an electric arc furnace is that if you've got lots of impurities, that it's then very expensive to sort out the impurities. But if you've got a high grade ore, you don't have those impurities to have to sort out is kind of the key point, and that's why it attracts a premium to what would otherwise be $105 a ton. You can get $125 a ton, so you're getting 20% more for your ore, because it solves a big problem for the producer, for the refiner. And the economics are just spectacular. Now, Cadence own 34% 4.9% of this mine, and it's a mine, it's a railway, it's a port. And this picture that you saw at the beginning, I mean, this is physically the mine. So it's all built. It's a brownfield site. This all needs reinstating. It needs revamping, bringing back to life, rehabilitating, and there's a cost to doing that, but it's not the cost that a brand new mine would be. It's because the railway's already there, the mine is already there, the equipment is already there. Obviously, some of it needs replacement and all the rest of it. Plus, they're obviously looking to optimize, how it was constructed and uh, operated 10 years ago isn't necessarily how it should be done today. So these numbers, and obviously there's a whole series of numbers, and these are just numbers over time. But when I wrote the article and included it in my 25/25, it was the 4th of December, so that's why we see that there. And 34.6% of a mapper is in the share price for what at the time was 5.6 million. So on the basis that these are both listed companies and they have a market price of £300,000, the remainder of that is a mapper. So the the price, essentially, if you're getting these things for 300,000 and deduct that out of there, you're left with that, which is then the the cost of a mapper. So to hold, to pay 5.4 million for 34.6% of it. Essentially, what I'm saying here is on the basis that the net present value of this project is $2 billion. For every 1 million of Cadence shares that you hold, that you own, you're holding, this 5 million here. 34.6% of this is 547 million pounds. So, for every 1 million that you hold of this, you own 101 million of a mapper, essentially. So you're getting it at over 99% discount, even though these other things have all fallen to bits. The European Metal Holdings, the Evergreen, the EG1, even though those things have all gone badly, it kind of doesn't matter because this is worth vastly more. Now, are you going to see 101.53 million for every million? If you went and bought the whole lot, would you physically get 547 million back? No, probably not. And I'm not pretending and not saying you would. In fact, I go on and I also make another set of assumptions that Sonora is worthless. It may or may not be. If it's ruled against the Mexican government, this potentially is worth 10 pence a share. It's worth 23 million quid. So, four times the share price back in, four times the share price when it was 2.5, 2.6. So it's and today, by the way, just to put you out of misery, it's not 2.5, 2.6, it's 1.6, 1.7 at the time I'm recording this on the 28th of December. It's a 4.8 million market cap. So actually, when we run these numbers on the basis that these are approximately still the same, which I think they are, you're actually only paying 4.5 million for 547 million. So I mean, let's just quickly grab the calculator. So you're paying you're not getting 101.5 million, you're getting 121 million per million pounds spent on Cadence shares. So the odds have moved even further. And actually, I think when I wrote this article, I'm not at all a mappy. and clearly these gentlemen aren't. Um, I think I sort of said here that on the basis that on the basis that this is now what are we saying here? This is now 1.5 pence, so the remainder is the market cap dropped down to 3.6, so it's obviously gone up by 1.2 million since then. But on the basis that you're getting 150 million for every million, so these are all just cuckoo crazy numbers. I mean, bonkers numbers, really. But are you going to get them? And I'm saying, well, no, don't. I'm not for a minute saying you will, but there are some further upsides. So that's one of them. EMH, EG1 could both, even though they are bombed out, we could see some progress in 2025. I mean, EMH are going to release their definitive feasibility study. These guys are still prospecting. These have got tin as well as lithium, so it's not just about. Obviously, the lithium is the key part to it. These are based very near German and Czech car production. That obviously there's a lot of stuff going on at the moment around that. So there are some other potential upsides, but I'm not sort of factoring any of that in particularly. I'm sort of saying, well, look, their listed price is this. Let's just consider that, nothing else. Although there are some possible upsides. The EBRD is one of the partners involved in the EMH project, for example. So what I'm saying is, well, look, the LO, the permit, the final permit needs to come through, and that's imminent. I mean, I think we're probably looking now at 2025, but we were sort of told around the end of the year, around end of 2024. So it's pretty imminent. We don't know the financing terms. That's a risk. So this is why I'm saying don't expect to get that full 101, 120, 150 million per million. That it's not going to be as much upside as that. But what sort of upside could we expect? Now, I suppose the reason I included this in my 2025 for 25, despite the inevitable, you're oak bloke, you always talk about speculative ideas, it's a load of rubbish, blah 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 blah. The odds on this, even after you consider that you're going to take a hit, and probably a big hit on the financing. I mean, let's paint a picture, let's paint a scenario. Let's imagine that the best deal that you can get competitively is that you've got to raise the finance, and the finance, by the way, is and you can see it here. The capex is 377.5 million dollars. Now we own 34.6%. Now that percentage might be a bit higher, but let's go with 34.6 times 377.5. So we've got to find $130 million to do all of this to get the mine back up and running, essentially. So it's the capex for the port, capex for the railway, capex for the beneficiation plant, for the mine. So some environmental community costs, and there's there's a big slug of contingency in there as well, like 10, what's that, 15% contingency. Indo-Sino are sort of the partners in this. So the assumption is that they're gonna stump up 65% of the capex. We've got to find 130 million. So let's imagine the conversation. Well, the best deal I can get is, and that 130 million dollars, I've said, that's 105 million pounds at the time, the FX rate. I'll lend you that 105 million, but my terms are that I'm going to take 70% of your equity, of your 34.6%. So rather than you owning 120 million for every million, you've just lost 70% of all of that. That's kind of like, I can't think that the terms would be harsher than that. But to me, that's quite an extreme term of I'll lend you the money if you give me over 2/3 of what you own. I'll leave you with 30%. But I make it even worse. I say, I'm going to take 70% and then I'm going to lend you, like, I'll pay my own 70%, but I will lend you 30%. So $39 million. I'm going to loan you $39 million, and then I'm going to charge you 10% interest. And out of all the proceeds from a mapper, the first 39 million plus 10% interest, which I've taken to be kind of 45 million, you've got to pay that back to me. So that would take, in my estimation, 1.5 years to pay back the loan, the $39 million and the 15 the 10% interest per year. That's kind of pretty horrible terms and conditions. I can't think that it would be worse than that. But even if it is as bad as that, then the economics are that this is going to generate, 5 billion of operating profits over its lifetime. We're kind of losing 70%, so we're left with 27.5. 1.5 years is lost as well. So if we only take 13.5 years that are remaining after the 1.5 years, I'm still saying that this is the undiscounted cash flows that you're going to get for the next 13.5 years. In other words, there's still a vast return. There's still a vast return. And I just can't see, no matter how onerous I make those terms, and this is sort of what I've pictured as the worst possible terms and conditions, there's still plenty of upside. There really is still plenty of upside to this. So obviously the risk is that nothing could happen, or it could all fall through, or nobody wants this green iron ore that and that was my next thought. So then I sort of thought, well, who would want this? And it was interesting because the first place I thought to look was, well, who used to own the mine? And it was, of course, Anglo-American. I mean, let's look at Anglo-American. Well, currently they're producing all sorts of, and this is their presentation from H1 2024, I think it was. So they're involved in all sorts of bits and bobs at the moment. They want to simplify all of that. They want to be producing, notice the words, high quality iron ore and copper. That's so they're offloading, and you probably read about this in the news. They're offloading their diamonds, they're offloading their they've got a sort of crop nutrients, phosphorus, I think it is, business. They've got various different things going on. This crop nutrients, Woodsmith. So they've got various different things. They're looking to grow their high quality iron ore. That's their stated strategy. And I mean, they're not going to be the only ones either. That obviously steel making is I think 7% of the world's CO2. So there's an increasing pressure on steel makers to make more environmentally friendly steel. And if you can make it in an arc furnace using electricity, and the electricity that potentially can come from Brazil has something like 80, I think 85% hydroelectric. So it's very, very, a Mappa state where a Mappa mine is based is I think 100% hydroelectric. So it's tick 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 around that. Now they've already got high quality iron ore mines, but their production. I mean, and I make this point that they want to grow their production from 60 million tons to 120 million tons in the next 5 years. Now, how long does it take to build a mine from scratch? There's no way that you will double your production by building a new mine in 5 years. It's just not going to happen. They haven't started building one, or they are looking to expand their I think it's the Minas Rio mine that is green iron. They are looking to, you can see it here, they're looking to grow it from 22 to 23 to 25. So they're getting what, 10% growth, 1 to 3 million tons more by 2026. But that's not 60, that's 1 to 3. So a mapper could almost certainly be a very, very, very good fit for Anglo. It's also the case that they boast about how they're focused exposure to premium iron ore, that they've got this many resources. Now the Amapa resource is not it's not as large as this. It's 500 million tons, but Amapa does have other nearby resources that aren't defined. There's no MRE, but it's likely that or possible, maybe I shouldn't say likely, it's possible that there'd be a contiguous resource with high quality iron ore beyond the direct defined resource at a mapper. So it feels to me like this could or would be a target. But of course, they're going to want to buy it with an LO and a DFS and maybe even that the whole thing's been built like here's a turnkey mine, here are the keys, off you go. They operate it, but only buy it once it's built. That de-risks it completely from their point of view. Or that they say, well, once we get to a DFS, let's do the rehabilitation ourselves. Like all the hard work's been done for them. They've just got to execute and then operate. So I don't know any of this to be certain. It, it's just my supposition. None of this is advice. None of this is certain or nailed on. But it's also the case things like this that they aspire to get their cost per iron ore ton down from 38 to 37. Well, it's interesting that a mapper is much below Anglo American's cost per ton at at an estimated 33.75. It's also interesting that obviously the economics on this are superb, really superb. I mean the return, $9 billion return over the 15 years estimated life, with a free cash flow of 4.7 billion. I mean, fantastic numbers, fantastic numbers. It's also notable that the directors, the Cadence directors, have invested 125,000. Might not seem much, but that's several months' pay. That 8 months' pay, 4 months' pay. So I don't know. I is it speculation or is this a calculated risk? And that's kind of what I'm treating it as. Could it deliver a 10 times return? Could it deliver a 20 times return? Possibly. Could it deliver more than 100%? I'd like to say probably. Does the risk outweigh? Yeah, these are all just value judgments, and I've got enough reasonably low risk ideas in my 25 that if this one just completely, um, I wouldn't bet the house on it. Um, but could this deliver a massive boost to the portfolio return in 2025? It's good to have one or two little, um, you know, ideas that could 10, 20 bag, in the coming year. Will it not happen in 2025? Will it take longer? I don't think so, because the LO is imminent. The DFS needs to happen. The funding needs to happen. I'm going to move on to the next article, because this article, I'm not at all a mapper, was because out of the blue, Cadence raised £1 million at 1.5 pence, which was a 40% discount to the share price. So it was trading at about 2.6, 2.7. They went and raised some money at 1.5, and the share price promptly dropped to 1.5. And then that caused me to write this article on the 18th of December. And you can get the clue here, Harumph and the sound of a calculator too, because my take on it was, I looked at it and said, well, based upon the price it's dropped to, well, this is now worth, even after taking into consideration, like you can see it here, that 1 million of extra shares at 1.5 pence is an extra 70 million shares. So that's 23% dilution. Remember, I previously said a few weeks before, expect 70% dilution. So 23 is 1/3 of the dilution I said to expect. So this is sort of happening to plan, should we say? But yeah, I suppose the other part to this, as well as sort of it suddenly being worth 50% more per million invested, and obviously that number has dropped a little bit since, but as well as it being worth more, you've also got this Pompea and Sazedas, that we also need to consider, that's part of this announcement. So what was this 1 million raised for? Was it raised because they'd run out of money with a mapper? No. I mean, it says here it will need to be used for working capital, its continued investment and associated working capital. In other words, they still need to keep the lights on. So there's probably some element of it going into a mapper, but did they need to raise a whole million? No. The reason they raised $1 million was for this, an investment into Hesperian, which is that funny named Pompea Sazedas mines. And I say mines plural because there's more than one. And these are previously producing mines that are based in Spain and Portugal, that have are polymetal, that have some interesting, and as part of it, the the directors do own 3.9% of the company, so they've crashed their own fortunes here. Having got the shares to 2.6, they've gone and cost themselves. So was this some dramatic act, or was it a plan? And my thinking here, and again, this is just my supposition, but it's my hopefully application of logic, is that the only reason that you would go and start messing around with some new mines would be because a mapper is kind of, obviously it hasn't been signed off, but the ducks are kind of in a row ready for when it is signed off, when the LO has been signed. So again, that's just my supposition. The other part to this is that these mines tenements are attractive. That talk about them here. I mean, there's clues. And these are just clues. There are clues like, as our project continues to advance and de-risk. So, what does continue to advance mean? In what way has it continued to advance? Like, the only explanation I can think of is that the financing side of it's been done. That's the continuing to advance bit. That's the de-risking bit. Because what else is the de-risk? Like, why say those words? Yeah. To me, there's no other explanation why someone would say those words other than that. Because the money itself, yes, working capital was needed, but the money itself wasn't sort of the reason for the de-risk. The reason for the de-risk is something else, and the something else, to my mind, is that the financing has been arranged, has been agreed. So the logical reason to start messing around with a new project and spending money at a discount, bear in mind that if you know what your financing discount's going to be, like, why would you take another 23% discount other than you want to have another project post a mapper, that it's life after a mapper? And again, that's kind of my supposition. But the new tenements, I mean, these are very, very good grades. I mean, no two ways about it. These are just samples, but these are shockingly good samples. And Nazi Germany, which obviously produced a lot of tanks and battleships, Bismarck, Tirpitz, a lot of U-boats, a lot of tanks, a lot of weapons. It took the might of the Western world, of the Allies, to stop Nazi Germany. Well, the Soviet Union as well. It took two superpowers to stop Nazi Germany. What was Nazi Germany's source of tungsten? It was Spain. That was it, Spain. At least to my knowledge, it was Spain. So Spain has got some very good tungsten. We know that from World War II. We know that from history. We know that that these sorts of grades would, at today's prices, be very likely to be very highly economical. I suppose they are just samples. I mean, we can't read too much into it, but we can read into similar and other mines in Spain. So these guys, Almonte, obviously they've got a mine in South Korea, but they've also got this Panasqueira in eastern Portugal, near the Spanish border. These guys are making very good profits. I mean, their profits are and they're expanding their mine because so the after extension and based these revenues, these are based on $290 a kilo. No, hang on, a ton. Sorry, just thinking about my tungsten prices. Yeah, it says here 390 a ton. So these prices are these economics. I mean, are very, 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 very good. I mean, this 35% margin, that's based on prices that are 33% higher today. So the extension would generate 29 million. I'm just trying to think where the EBITDA margin is there. So that's 12 million. 35% of 36 million would be 12 million. So at today's prices, I mean, we're looking more like 29 million profit. So that's kind of 75% margin, something like that, which is phenomenally good. So and equally, antimony, they've talked about having antimony samples. Again, that has increased in price. That's a mineral that's subject to restriction from China. So again, nothing here is nailed on, but did 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 the price fall make me regret the fact that I'd included Cadence? I mean, I guess hindsight's a wonderful thing and all of that, but no, I think I looked at it a very different way when I saw the news. I ran through all the numbers. I ran through and I had a few people comment about my idea saying, oops, and 40% off sale and blah, blah, blah. That's one way to look at it. Another way to look at it is, as I say, to get the calculator out and to say, well, look, if we sort of say, that dilution means that we've lost the equivalent of 2.8 pence per annum from a mapper for 13 and a half years, that's the cost, and that's still based on that 70% assumption and then paying for a loan at 10% interest. It basically takes a further chunk. So that's what I show you here, that I'm sort of saying that it's gone from being £1.57 worth of value to £1.20, so it is a drop. But you've got to kind of also then think, well, what, like, that extra working capital, will that increase the percentage? So I say here, if it increases the percentage from 34 to 35.8, for example, then you've got to sort of consider, well, you've got an extra chunk of that 2 billion NPV. So you've also got the idea of what's the value of those new mines in the fullness of time. Could they deliver more than 36 pence per share to shareholders over their lifetimes? I mean, let's say a 20-year life. I mean, can they deliver 1.8 pence per share to shareholders? We're only really talking on 300 million shares, 1.8 pence. I mean, let's just sort of quickly do that. So 297 million shares times that 0.18. Can they deliver a 5.3 million profit per year? I mean, we've just seen that Almonte mine, that's not anything special in terms of grade, is doing that and then some. So look, do I regret it? No, I don't regret it. I'm pretty comfortable, actually. As I say, I mean, nothing's nailed on, but all I can think is, well, why would they agree to that new project when it's impacting the old project? And the only reason I can think of is that the Amapa project is lined up for sale. And that's going to happen. It may and if it happens, it's probably potentially going to happen quite early on in 2025. So it may be that it realizes at so and so price. There's then a ton of money that goes into the development of the tungsten and antimony and so on mines in Spain and Portugal, and that as well as maybe some form of special dividend back to shareholders. I don't know. As I say, these are just ideas, but that's my rationale. That's the reason I picked it. Is it a high risk? Yes. Should you bet the house on it? No. You do what you like. It's your investment decision, not mine. But that's why I included it in the Oak Bloke 25 for 25. So thank you very much for listening, and I shall return for idea number 10 in the next video. Cheerio.